We don't just build wealth, we build legacy. Welcome to the Retirement Income for Life show with Doug Vincent. For over 30 years, Doug has helped families right here in the DC area turn hard work into lasting income, helping you protect what you've earned, provide for your family, and retire on your terms. This is where preparation meets opportunity. This is the Retirement Income for Life show. Here's Doug Vincent.
What you don't know can hurt your retirement. This is why financial literacy is so important, especially for pre-retirees and even if you are already retired. Welcome to the show. This is Doug Vincent. Shout out to all my listeners in Washington, D.C., Maryland, Virginia, the DMV area. We are excited to be with you once again. We are scheduling a lot of 100% free complimentary consultations. Make sure as a listener, you do not forget to take advantage of that. We want to dig into your pre-retirement financial situation, your family, and if you own a small business or anything you might be dealing with as a retiree or pre-retiree, no obligation. Get in touch with us and we can schedule that for you today. Also, our podcast and our YouTube channel, our Retirement Income for Life. Tune in to this episode, older episodes right there on our YouTube channel. We look forward to working with you and you getting caught up on all the things we've been discussing over these last few weeks. Don't hesitate to give us a call, 301-242-3950. As well as our website, our website, Retirement Income, the number 4, life.com, our phone number, 301-242-3950. So we're going to dig in today on financial literacy. And April is traditionally when we celebrate Financial Literacy Month, but Financial Literacy Month applies every month. Okay. And so here in July, we want to dig back into that and look into this information related to your financial planning and your retirement planning. And, please don't hesitate to get in touch with us as we go through some of these very important topics. We're going to highlight today some often overlooked financial topics that could really trip you up in your retirement journey, as well as your pre-retirement journey as well. We'll look into some of the biggest retirement blind spots. There are a number of blind spots in retirement that we want to make sure that you're planning to not be blind with these. You need to plan for your retirement in some of these specific areas, and we'll go through our financial checklist as it leads up to your retirement. And, we want to make sure that you're not one of those people that overlooks this very, very important topic. It's very important that you look into that. Also, we'll talk about savings. Okay. Your savings to income, your accumulation of assets that are liquid. And then now, how does this wealth then distribute as income when you get to retirement? Accumulation strategies are not the same as income distribution and asset preservation strategies. We'll look at how you can turn the corner on your accumulation process now, moving into when that money needs to distribute. And we'll focus in on the income related to that. Then we'll dig into your taxes and retirement. Do you need a Roth IRA? What are RMDs? We want to cover the basics of what that's concerned, and the different types of accounts and how they are treated related to tax purposes. And then finally, we'll end today's show talking about retirement income planning. Do you know, think about this real quick. Do you know how much income you need in retirement? Once you leave that job, once you are now fully retired, how much income do you need each month to make sure your expenses are taken care of? Okay, this is something that you must consider as you move into retirement. Retirement income planning is much more important than you just saying, when I get 65, I'm retiring. Because you might be back to work at 66. It's the income, not the age. Okay, we'll discuss the old rules of thumb, those old rules may not apply anymore. And we want to talk to you about what to do instead of some of those old rules of thumb. All right. So our financial wisdom quote of the week, as we always try to give you, comes from Mr. John W. Rogers Jr. John W. Rogers Jr. says financial literacy is just as important in life as the other basics. Financial literacy is just as important in your life as all those other basic areas of literacy that you may focus in on, and then leaving out the financial literacy. Okay, you may be sharp as it relates to your relationship literacy or your spiritual literacy, but don't leave financial literacy on the table. As I mentioned, that April is traditionally on our calendar year financial literacy month. This is July, and we want to just give you some reminders on when it comes to your money. What you don't know can really hurt you. Okay, when it comes to your money, what you don't know can really hurt you. And so most people were never taught these literary areas. These are areas of literacy most people were never taught. And most people were never taught how retirement actually works. Do you understand that? Do you know how retirement actually works? Okay. There's no class in school for retirement. Okay. There's no class in school for Social Security strategies. Okay. You don't have any classes in school related to tax planning in retirement. And you definitely don't know how to turn your savings into income. These are some of the areas that people just aren't literate in. Okay. And, this is an area that we focus in on a daily basis. We make sure people understand these key concepts, and these things that they need to know are just important as any other areas in your life. And, maybe in a lot of cases, more important. Okay. So let's give you the big picture here. So financial literacy gaps that we see, in America today, right? Studies show many Americans struggle with basic financial concepts like inflation, compounding interest, risk, different ways of having your money at risk. And should you be taking some risk off the table the older you get, or is your portfolio too heavily at risk for the age that you are, right? The lack of understanding in a lot of these areas can, lead to some real costly mistakes for you as you approach retirement, or even for those of you that are already in retirement. Okay. Now, the closer you get to retirement, why does this matter so much? Why do you have to understand these concepts, these risks? Is because you have a lot less time when you are retired to recover from market downturns, or to recover from any mistakes for that matter. Okay. Once you get to the point where you are no longer contributing to your 401k, okay, you're no longer getting the match. You've accumulated a certain amount and you're taking out withdrawals. Certain mistakes of how you have put your portfolio together can be decisions. There can be some decisions that you are permanently affected by that can cost you over time, and especially around the area of income. Income is the most important thing to consider as a retiree, okay, as well as, okay, those areas like your pension or Social Security. Okay, so the decisions that you make, the mistakes that you could potentially make, we want to help you take those off the table. Okay, and if you've got questions about that, you can, as I've mentioned to you before, we have a free download for you. Go to our website, retirementincome4life.com. At our website, we've got a retirement income for life survival kit that you can download absolutely free. Okay, this will help you with some of the understandings of mistakes that could be made, or retirement challenges that you might face. And, this can also help you get prepared for a meeting with us, your financial advisor, or just whoever helps you prepare your retirement income planning, your pre-retirement planning. Give us a call, download the free survival kit, set up a free 100% free consultation with us. Give us a call, 301-242-3700. 3950, or you can set up a Zoom meeting or an in-person meeting. Our office is right here in Greenbelt, Maryland. Retirement Income, the number 4, LIFE.com. Do not go into retirement and not know if you are making mistakes. Are you set up to fail and you don't even realize? Okay, we don't want to have that happen. Okay, and so there can be some real big blind spots when it comes to pre-retirees preparation, as well as those retirees that are already in retirement. Okay, so let's start with the biggest issue. One of the biggest issues we see, one of the biggest blind spots, right? And these aren't necessarily bad decisions. Okay, a bad decision and a blind spot, are simply two different things, right? And so simply putting a plan in place, okay, is one of those things to where you see people being derailed if they don't have a solid retirement plan in place. Okay, this could be something that you just haven't even thought about. Okay, you thought about, hey, when I get to this age, or when my pension is going to pay this, my Social Security is going to pay this, but have all the dots been connected in a written formal plan? Okay, and that's a big blind spot for a number of pre-retirees and retirees in America today. So most people, listen here, most people spend time planning a 2-week vacation that they do planning for retirement that could last 3 decades. Let me say it again, so I don't mislead you on that. Listen very closely. Most people spend in America more time planning a 2-week vacation than they spend planning their retirement that could last 30 years. Okay. Is that you? Have you already planned your vacation for the summer? You've been working on this thing since February, but you don't have a retirement plan and you're retiring in December. Okay. You've got to put something on paper. You've got to talk to people. You can't assume what Social Security is going to do and how your 401k is going to work in as supplemental income. Retirement today is a lot different than it was for your parents and mine. Okay. The generations before us and what we're facing today is completely different, right? The margin for error today has gotten a lot smaller. Okay, a lot smaller today. And one of the reasons why, and one of those blind spots, is because people are living longer. People are living longer today than they did when our parents and their parents were coming along. It's nothing for me to have a meeting during a week. If I met with 15 people during the week, someone that's 85 or someone that's 88 or 89 years old, people are living longer. You have got to take off the table what we call longevity risk. Okay. According to the Social Security Administration, a 65-year-old man today has a decent chance of living to the age of 84. Okay. If you are a man today listening to this and you're 65 or over, you've got a decent chance today of living to the chance of living 84. Okay. 84 or older. Okay, good chance of doing it. If you're a woman today, the age is 86. Okay, if you today are just looking at those averages, okay, and you retired at 65, that means at least another 2 decades in retirement. Okay, yay, 95, that's 3 decades, or 96, 3 decades. Okay, those are just averages. And, for married couples, both age 65, there's a 50% chance that at least one of you will live past the age of 90. Okay, that's a stat that is very easily tracked, very easily looked at today. It is not uncommon for a retiree today to have a 25 to 30 year retirement. And guess what? That money has got to last decades. Okay, cost of living is going to show up. Inflation is going to show up. Okay. You need built-in raises that are attached to some of the liquid assets that you have put in place so that you're not turning on all the income at once. Okay. You may need $20,000 a year from your 401k in 2027, but you might need 40,000 in 2037. Okay. Have you made those provisions to supplement your income, supplement your Social Security, supplement your, your pension if you're getting one? Have you considered that you might make it to age 90 or 95? Okay. Those accounts have got to last, for a long period of time. All right. Blind spot number 2 is healthcare costs. Okay. Is healthcare going up or is healthcare going down in America? Think about what I just said. I believe healthcare costs will continue to rise as you and I get older, and Fidelity estimates that around $300,000 for a retired couple is what they're going to need over the course of a retirement lifetime. You're going to spend over $300,000 on healthcare costs, and that can come from a lot of different places and a lot of different ways that could play itself out. Long-term care costs, simple costs for Medicare, your Medigap plan, your supplemental insurance, your vision, your dental, your hearing could come from a lot of different places. Your prescription costs, right? The real issue here is a lot of Americans are not preparing for the risk of healthcare going up. Okay. Most people budget for routine healthcare. Most people in America just budget for routine healthcare. They don't plan for the catastrophic stuff. They don't plan for the Alzheimer's. They don't plan for the dementia. No, I hope it doesn't happen to you. But if it did, you should have provisions already in place. You should have that risk taken off the table as a part of your full retirement income plan so that your savings isn't wiped out with one catastrophic event. All right. Got to take that blind spot off the table and do some planning around that particular area. Okay. Number 3, inflation. Okay. Inflation and cost of living are tracking together at about 4.8%, almost 5%. All right. So what does that mean? If you retired at 65 on a fixed income of $6,000 a month, okay, by the time you make it to 75, okay, that $6,000 is not going to purchase the same amount of goods and services that it did 10 years prior. What about 20 years from 65? We just described that a number of people might make it into their late 80s and 90s. Okay, so you have to make provisions for the risk of inflation, and it's tracking alone at about 3%. Then you add on almost another 2% for cost of living. That's going to be a challenge on top of your healthcare costs that are probably rising. Okay, you see why this planning is so important. Do you see why this retirement income for life strategies and literacy are so important to know these statistics? And then how does it uniquely flesh out, for you? So let me give you a quick scenario. So let's say your expenses today are $60,000 a year. Okay. $5,000 a month, and that feels, manageable, for you. 20 years into retirement, with modest inflation, all right, you might need $100,000 a year to maintain the same lifestyle that you had 20 years before. Okay. If your income sources are not outpacing inflation, and I've also mentioned cost of living, if you just have a fixed pension, that the cost of living adjustments are not higher than cost of living and inflation together, and you don't have a plan for supplemental income from that 401k or other liquid assets, you're going to feel that squeeze more and more each year. All right. Last risk we'll talk about that we've mentioned before, and that's called sequence of returns risk. Okay. When the market turns down and you're taking money out, okay, and you haven't invested in a place to where it's too much risk, you could see over the course of time your portfolio not being able to last into your 90s or late 80s. Okay. And, this is called sequence of returns risk. It's one of the most misunderstood dangers, in retirement planning. And what we always say, have a strong accumulation strategy when you are able to contribute, when you are able to get matching from your job. But when you shift into a distribution strategy, you have to make provisions to do asset preservation. Okay. You can't just ride out the downturns in the market anymore. Okay. You don't have the time that you had when you were in your 30s or 40s or 50s. Okay. You don't have the time that you had in your working years because you need this money to live on. Okay. So you're taking out money, you're taking raises, and the market just went down 30, 40%. You didn't take any of the risk off the table. You can literally go through a lifetime of savings, 10 or 15 years. You might have run through all of that money that was supposed to last 30 years. All right. This is not that you're doing something wrong. It's something that you just don't know. Okay. So many people don't know this. Okay. And they don't know how to plan for this. All right. So the truth is, most people don't discover these blind spots until they're already in retirement. Okay. You got to plan for this before retirement. If you're already there now, you got to get a plan in place. Even if you're already in retirement at this point, after retirement, your options could potentially be limited. Okay. You don't want to limit your options. So this is why it's so important, as a pre-retiree to get this in place. Okay. Whether you're a pre-retiree or a retiree already, you have to get a stress test on your accumulated assets. Okay. You have to let somebody help you with a stress test of risk and longevity and healthcare costs, which we've discussed, and inflation, sequence of return risk. If you've never had a stress test on your portfolio, that's something, of course, that we can help you do. Okay. We'll walk you through your situation, show you where your gaps might be. We don't want these to become problems, and then you address them. All right. So give us a call, 301-242-3950, 301-242-3950. Set up a stress test analysis with us. This is something that we're doing on a weekly basis right here in Greenbelt, Maryland. Or we could do a Zoom. We work in all 52 states. We are in the DMV area, right in Greenbelt, but we can do Zoom. We can do in person, whichever fits best for you. Okay. Go to our website. Okay. You can also register for this consultation right there on retirement income, the number 4, life.com. Don't hesitate to put that in place, and we will help you with that stress test. All right. So let's shift gears from another very important topic in retirement. And we want to call this from saving to income. Okay. From saving to income. Okay. This is a big change in your retirement. You have shifted now you're shifting now to a distribution strategy. Okay. You've had an accumulation strategy during these working years. Okay. You focused in on growth depending upon what your, risk tolerance was. And, are you conservative? Are you aggressive? Are you moderate? Whatever it might be for accumulation. But as you prepare to shift into a distribution mindset, your risk tolerance may have gone down. Okay. And you want to focus now on income, moving from distribution. Okay. Shifting from growth for the most part to now asset preservation. You don't want to have all your money out of the market, but you need to do the stress test analysis and the income plan to determine what percentages should no longer be at risk to the market volatility that could be very, very dangerous, right? If you were, having to sell shares when the market is way, way down. Okay, so here's the reality. A 30% market drop when you're 45 and still contributing to your 401k is a buying opportunity. Okay, but the same drop in your second year of retirement when you're pulling $50,000 a year to live on can be devastating. Okay, you've left the growth area. Okay, you're taking money out, right? And this is why the large balance is not always enough. Okay, a $500,000 or $1 million portfolio, it sounds great. Okay, and if you follow the traditional 4% model for withdrawal, that's $40,000 a year before taxes. Without a plan, though. Okay, it's easy to either overspend, right? In those early years, we call those the go-go years between 60 and 70, right? or underspend out of fear. So you're not even living the life you want to live. You're not enjoying yourself of all the hard work that you've done to accumulate all these assets. And so we start to see people that are focusing in on account balances, and they forget the real question. They forget the real question. And that is, what does this actually provide? What is this income actually providing for me on a monthly basis? It has to be connected to time. Okay. That's the key point, right? And so when your large balances aren't enough, you've got to have the withdrawal strategy. Okay. That withdrawal strategy is ultra important. Okay. And so let's talk about that. So the order in which you withdraw funds matters. Pulling from your 401k first, right? Is, you understand, that's fully taxable. So if you are formulating a retirement income plan for life and the withdrawal strategy includes in your first few years your 401k, you've got to factor in that all that money has grown tax deferred and it went in pre-taxed. Okay. So in this situation, you are in a situation where if you took that money out, it's taxable. Now, your Roth IRA, if you have that, that's tax free. Okay. And brokerage accounts only, tax, in gains, right? You only, in those brokerage accounts, you only are paying capital gains tax on those. So there's different withdrawal strategies for different accounts that you have, right? This sequence that you begin to take withdrawals from these different places can save you tens of thousands of dollars in taxes, over the course of your retirement, right? And so taking too much too early, 7 or 8% in the first 5 years, because the money's there, could permanently damage your long-term sustainability, especially if the market drops, right? One other thing to consider, and that is what we call required minimum distributions, and they will kick in at the age of 73. Okay, required minimum distributions. Right now, if you aren't taking money out of an IRA or 401k, that's going to change when you get to the age of 73. Okay, and so if you don't plan for how that's going to happen, you could get pushed into a higher tax bracket, and then now you're trying to manage your income carefully, and that's just not something that you really want to find yourself in that place. And look, withdrawal strategies, it's not sexy, but you got to do it right. Okay, this is something that can extend the portfolio life for many, many years. Okay, you want to make sure that as you're creating this retirement paycheck, from supplemental income, from that which isn't your pension or that which isn't Social Security, right? You want to make sure you understand the tax advantages of potentially a brokerage account, or let's just say even a savings or checking area, before you deal with your 401k or TSP or these accounts that every nickel that comes out, you're going to be taxed at ordinary income. Okay. Social Security normally forms the foundation for most people, right? This is that one guaranteed, they have inflation adjusted, raises for you, and, they don't have to do it, but they have consistently done it. And, those that are deciding to claim, whether at 62 or your full retirement age or the age of 70, this is a decision that also should be strategized, but that's kind of a foundation for most Americans, right? Now, for pensions, they're going to provide stability if you have one. Okay. Everybody doesn't have a pension. Like I said, our parents or their parents were depending a lot of times on pensions, and that's not something that a lot of Americans can depend on. Are becoming more and more rarer, and if you have them, great, definitely plan along with Social Security and how that should be distributed. But many people today, their pension is in the form of the 401k or the TSP or the 403b. Okay. And the reality is most retirees feel more secure when they know exactly how much is coming in each and every month. They want to remove the guesswork and stress of managing these withdrawals on their own. Okay. And so this is where that planning comes in place, especially if you only have Social Security. Okay. That's very, very, very important. All right. So as we look to retirement with those funds that have accumulated all these years and you have invested over the course of 25, 30, 35 years. Okay. Now, as you move into retirement, you want to balance out stability and growth. Okay. Stability and growth needs to be balanced out. Okay. And so you still need growth to fight inflation. All right. So once again, I don't believe in taking all of your money out of the market, but you may need to take some out and then not be too conservative, but be conservative enough that you can take care of your income problem while you still keep pace with cost of living and inflation. And that's where the growth comes in, right? So it's a shift in focus. It's a shift in structure. And those strategies need to be aligned with your unique, situation. Okay. And so a common approach is to keep 2 to 3 years of living expenses in cash or short-term bonds. Okay. This just in case the market drops, you don't have to be forced to sell off all your stocks that were, earmarked for growth, or your mutual funds or your ETFs, whatever it might be, and in this way, you can ride through those normal waves of a long-term bear market or short-term bear market or, intermediate bear market. You can ride those waves out because you had 2 to 3 years of expenses that were in checking, savings, money market, things like that. The goal in retirement is to sleep well at night. Okay. You're not going out working 40 hours a week. You want to sleep well at night, knowing that you can pay your bills year in and year out. Okay. Knowing in month to month, no matter what the market does, you've taken the risk off the table to handle short or intermediate term, challenges. Okay. And you want this portfolio that you still have growing. You want it to work and to support you 15, 20, possibly 30 years. Okay. Most people don't retire on a balanced, growth in income, posture. You don't just retire on that balance you have in your 401k. Okay. You retire on income. You don't retire on assets. Just because your balance sheet has all this land and all these cars and all these possessions, okay, that is not going to pay your mortgage or your living expenses or your fixed and variable expenses, your travel. All the things you want to do in retirement require income. And guess what? That income needs to be predictable. Okay. Not only predictable, it needs to be sustainable. Right. And this is why you need a plan that is structured in a way that supports the life you actually want in retirement. Okay. So pause right here real quick. Have you mapped out your dream retirement? Okay. Do you know what you like your dream retirement to look like? Okay. If you do not map out a retirement income plan, and I pray a dream retirement income plan, it could potentially end up being a nightmare. Okay. If you're not looking at these areas, you must start focusing in on them. And you want to know what your savings actually looks like. Okay. How does this turn into a monthly paycheck? How can I take what I've saved and create potentially my own self-directed pension? Okay. Create my own dividend income sources. Is it gonna be enough for me to last 10, 15, 25, 30 years in retirement? Okay. Give us a call, 301-242-3950. We would love to help you in this area. Our website is retirement income, the number 4, life.com. We are doing these consultations every single day for our listeners. And as we are working with you, we make sure that we sit down and we review your full retirement income picture. We get to know your goals and the retirement lifestyle you're working toward. And hey, you may already have a plan in place, and we are not in the business of taking a plan that's already good and, making changes, but you also may have gaps. You may have investments that you're not aware of. And the plan you currently have may not align with your retirement needs. Okay. This evaluation needs to be clear, easily understood when, if we make some recommendations, how you would move forward, you having clarity and confidence on how to set up, something of this nature. If you've never done this before, it's time to start now. If you've already begun, a second opinion may be good. You must take action, once the questions are answered and once you are moving forward and you feel good about your situation, take the guessing game out of it and then look to move forward. Once again, 301-242-3950. We are here to support you every step of the way. Retirement Income, the number 4, LIFE.com. All right. Let's talk about demystifying retirement taxes. Okay, let's take off the table the demystification of retirement taxes. So let's talk about, that's something that surprises a lot of people. Taxes in retirement, people are thinking just because I'm 65, my taxes should go down. Taxes are based on income, not age. Okay, how much income distributes means how much whatever your tax bracket might be. It has nothing to do with age. It's how much that distributes. Okay. The IRS is going to treat your retirement income from various sources, sometimes very differently. And without proper planning, you could be writing a much bigger check in taxes than you ever had anticipated. Most people, they spend decades saving for retirement, but very few spend time planning for that tax bill that comes, when you haven't done the planning and the money's coming out of the buckets that some that are 20% tax bracket, some that are in the ordinary income tax bracket. You've saved in taxable accounts, tax deferred accounts, tax-free accounts. Okay. And if you have, money in all of these buckets, okay, as they begin to distribute, okay, you need to know, having this money, in one bucket alone could really limit the flexibility that you have, because you don't want to move yourself into too high of a tax bracket, even though you still need funds, to meet your monthly expenses. So if everything's in a tax deferred account, that means money went in pre-tax, it grew tax deferred. Every dollar you need is considered a taxable withdrawal, and you cannot manage those brackets related to what they set in place on a yearly basis. The only way you can manage that is how much you take out. Okay. And so that's very important as it relates to understanding how your money's taxed and where that money's coming from. Okay. Let's talk about the tax time bomb. Okay. Tax deferred accounts are designed to grow. And the larger they grow, the larger your future tax bill can become. All right. The Tax Policy Center has called this the tax time bomb. It's a ticking time bomb. Right. And here's an example. A 50-year-old with 400,000 or 401k growing at 6% annually will have roughly 1.28 million by the age of 70. Okay. At a 24% tax rate, that's over $300,000 in future taxes. And if the tax rates increase, think about it. Are taxes going up or taxes going down? If you had to guess, would you think the 24% tax bracket could possibly be 26 or 27 in the future? If I was a betting or guessing man, I would say yes. Taxes are probably going up. Okay. And, this bill is probably going to be higher the older you get. So many retirees don't spend down these accounts early because they're worried about running out of money. Right. So these accounts keep compounding along with the compounding tax liability. OK. And so all of this comes to an end if you're not using this before your required minimum distribution age, all of this eventually is going to come to an end. Do you see why tax planning needs to be done before you hit the age, in this case now, of 73? Okay, you have to do tax planning in your 60s and 70s at the latest before you get to 73. And then they're talking about that age moving to 75, which still will come, very, very quickly. And so this is where the IRS, require minimum distribution. Let's call this when the IRS has stopped being patient. Okay. And so RMDs now begin at age 73. And, for those born between 1951 and 1959, that's going to be age 75. And those born, 1951 and 1959, age 73. Those born after 1960, the age currently is going to be 75. So which camp do you fall in? All right. 51 to 59, 73. Okay. Or you who were born in 1960 or after, 75. Okay. You must withdraw a specific percentage each year that increases as your age increases. Okay. At 73, that percentage is approximately 3.77% of your balance. Okay. So you take 3.77 of whatever your qualified plan, your tax deferred accounts are. 3.77 is what you're going to have to take out at 73. Now, by the age of 80, okay, it's 5.35%. Okay. By the age of 90, it's 8.77%. Do you see why, even though the IRS has been patient with you, do you see why it's now time, if you are approaching these ages and the required minimum distribution, you've got to do some planning around this. They're not going to make any exceptions for you. It doesn't matter who you are. You must take these withdrawals, whether you need the money or not. Okay. Missing RMD. Okay. And the IRS imposes a 25% penalty on the amount you should have withdrawn. Let me say that again. You did not take out your required minimum distribution. So the IRS comes back and says, pay 25% more of that 3.77% or whatever it is. Okay. Now we're really running through a life savings very, very quickly because we didn't understand the rules. We didn't know that we had to do this. And look, practically speaking, if you have $1 million IRA at 73, your first RMD is approximately $37,700. Okay. You got to add that to your income now. Okay. That 37.7 is considered income, right? And you add this to your other income, and now you're taxed at ordinary income, just like you got a W-2. Okay. For many retirees, RMDs alone push them into the 22 or 24% federal tax bracket. And we haven't even added in state taxes. Okay. So planning must be done around this area. Okay. Let's talk about Social Security taxation. Here's what shocks people according to the IRS. This publication 915, right? A lot of people don't think Social Security is taxed. No, up to 85% of your Social Security benefits may be subject to federal income tax. Okay. Only 15% in a lot of cases may be off the table for taxes. The IRS calculates your combined income, okay, what we might call your provisional income, your adjusted gross income plus your tax exempt interest plus half of your Social Security. Okay. So combined income between 25,000 and 34,000, right? Single taxpayer, right? Or 32,000, between 32,000 and 44,000 total income, married. Okay. That means up to 50% of your Social Security is going to be taxed. Okay. Now, combined income levels as a single filer that exceed 34,000, right? Or a married couple that exceeds 44,000, up to 85% of your Social Security benefits are going to be taxable. So just think about that for a second. In the DMV, especially, per capita income in our area, 150 to 180, real easy to have high incomes in retirement, especially if we're adding it all together and we're talking about the provisional income. Okay, even with your write-offs, more than likely, 85% of your Social Security is going to be taxed. Okay, could there be some tax planning around that? Possibly. Are there strategies that may keep you below that threshold, maybe where you're paying 50? Possibly. Okay. And so These thresholds were set in 1983 and have never been adjusted for inflation. Back then, only 10% of beneficiaries paid taxes on Social Security. Okay. Today, it's over 50%. Okay. So back in the 80s, only 10% paid on Social Security. But now, cost of living inflation, people are making more money. It's a stealth tax increase that catches retirees completely off guard. The planning around income distribution is very, very important for retirees as they are planning to understand how not to pay, overpay in taxes. Okay. A lot of times, not all times, this is why we talk about Roth conversions. Okay. Roth conversions may be the solution to keep you from going above 44,000 or more in taxable income, right? Because if you have enough time to plan, you can pay the taxes early before the taxes become more expensive, and you could have moved money into a Roth IRA, and then the 5-year rule kicks in that you may be able to distribute that money tax-free from a Roth after the 5 years, have, been set in, and you could potentially be eliminating taxes, for later, right? You take money from a traditional IRA. This is how you convert to a Roth. You pay income tax on that amount you take out. You can't just move it from one to the other. Whatever the amount is, you convert it and you pay the tax in that current year. Once again, are taxes going up? Are they going down? Would it be more advantageous for some of you to pay the taxes to convert to a Roth now than to try to wait till later and have money distributed, or even try to convert later? Okay. In a lot of cases moving forward, paying the tax now makes a lot of sense. Okay. The money grows tax free. All your distributions are tax free. And so this is one of those, what we call a tax arbitrage, that, you convert in lower income years and the lower rates, and this could be a time where you literally can have some future protection. In a lot of cases, maybe no RMDs. And then you can do some Social Security management as well. This strategy is converting just enough each year to fill up your current tax bracket without jumping to a higher one. Okay. Oftentimes we can move 30 to 50,000 annually during your 60s and 70s. And over the course of a 10-year, 7-year, 8-year period, now that strategy has paid off. The money that grew in the Roth IRA now pays you back from the taxes that you have accumulated. And when I say pay back, your balance is now the amount of money that you've transferred plus the growth. If you add those together, it's the amount that you paid in taxes or more, as well as the balance that you started with your traditional, plans, right? The question isn't whether you'll pay taxes in retirement. Okay, so let's take this off the table. That's not the question. It's when. Okay, you're gonna pay taxes in retirement on some level. Okay, but when are you gonna do it? Maybe it's better to do it leading up to retirement, right? How much is it gonna be? Okay, can you control over time how much you paid in taxes because you did strategic tax planning? Okay. The difference between someone who plans and someone who doesn't, you can easily see potentially 6 figures higher in taxes that you didn't have to pay because you didn't put the plan in place 10 years ahead of time. All right. So have you mapped out your tax picture for the future related to income distributions, where the money is going to come from? Right? If you don't even know what RMDs are, what they look like, or how your Social Security is going to be taxes, it's a huge opportunity in these summer months. If you're retiring at the end of the year, you have to get a plan in place. Give us a call, 301-242-3950. Go to our website, retirementincome4life.com. We will work with you 100% free. We'll give you a consultation, talk you through all of these areas, schedule this complimentary tax analysis, schedule a time to talk about a distribution strategy that, you want to keep more money in your pocket in retirement, and that you don't have to pay more than necessary in retirement. Okay, so let's talk about that retirement income planning. the solutions that you need, the planning to put in place. And here's one of those main questions that we hear often. And it basically is just a general question of how much do I need to retire? Okay. How much do I need accumulated to retire? And the better question should be is how much money do I need as it relates to income to retire? What kind of income replacement do I need to come from my 401k, TSP, 403b? What income do I need to come? My salary's not coming in anymore. Okay, this is my expenses, and this is the salary that I'm used to. This is the revenue I'm used to. Okay, how can I create a reliable retirement income plan that shifts from earned income from working 40 to 50 hours a week to now income distribution from a number of different income sources? This requires a lot of different types of planning. Okay. And this is planning that you have to put in place. It's income, not accumulation. Okay. So let's dig into some of these things that, have traditionally been guidelines. And one of them is the 4% rule. Okay. And it suggests if you withdraw 4% from your $1 million portfolio a year, that this could potentially last you for 30 years. Okay. But what if your retirement lasts you 35 years? Okay. What if you had to take out more than 4%? What if you did cost of living and inflation adjustment raises for yourself and now you're taking out 7%? Okay. What if the market went down and you still had your money invested for market volatility, just like you did while you were working? Okay. You have to put in some plans that go above these rules of thumb that we are used to, from the past. Okay. The foundation is making sure that what essential expenses you have to cover. Okay. So we know, hey, man, maybe my guaranteed income, my Social Security, my pension is going to take care of my fixed expenses, but all of my variable expenses, I want to come from my supplemental areas. And I don't want this money to run out because I don't want to stop taking the trips. I don't want to stop having fun with my grandkids or whatever discretionary spending you may have. This is what this money has to last, the next 20, 25, 30 years. Your travel, your hobbies, right? You may have family members that you need to help, right? You may want to give to different organizations that you are involved with. Okay. There are different line items that must be planned as you move forward, and they can't be just afterthoughts. They can't be frivolously done. This is something that, and cost of living, inflation, bad decisions on withdrawals, how you are distributing this money, can really be what we call a silent threat to how you actually finish this thing. Okay. And so as you move through, the retirement income plan, right? In a lot of ways, as we've said before, you've got to create your own pension. Okay. Annuities can replicate pension-like income. You can create your self-directed pension a lot of times using an annuity, right? Converting a portion of that savings into an annuity, taking it out of the market, and it's now in an insurance contract that is set up just like a pension, right? There are core benefits to it. It works for some people. It doesn't work for others. But what I'm describing to you is guaranteed income matters. And you need as many areas that you can develop in retirement that these are guaranteed income situations. Okay. You definitely want to balance out the growth, but you also want to balance out the guarantees. Okay. The flexibility needed in a retirement income plan, like I've said to you many times before, you don't want to take all your money out of the market, but you want to have enough out that is in place for guaranteed income. Okay. You cannot afford a market downturn and you were expecting that money to last a lifetime. And now you're not contributing to it. You're not getting matching. Yes, flexibility matters, but guarantees matter even more in retirement. Okay. And so we don't know what's going to happen with your health. We don't know what's going to go on in the market. We don't know your family dynamics, right? Your goals are going to shift. The way things look now, okay, things will change over the course of 3 decades in retirement, 2 decades in retirement. Okay. Build into this retirement income plan regular review points. Okay. Annually, we're doing audits here. Annually, we were doing reviews here to make sure you are reassessing whether your income plan still fits for the retirement income for life that you want to have. Okay. So we've talked a lot about financial literacy. Great reminder here in the month of July. You know, this knowledge is powerful. Okay. But you got to act on it. Okay. The more you understand, the more control you have over your financial future, your retirement future, right? If you're within 6 months of retirement, 1 year, 3 year, 5 years, you got to get going. Okay. Give us a call, 301-242-3950. Always our website, retirementincome4life.com. We look forward to helping you with all your retirement planning